Welcome to today's Explainer. We're setting the stage right now for a rapid-fire masterclass on risk management and market mechanics. If you want to understand how institutional traders actually operate, how they manage their risk, and how they optimally scale their positions, well, you're in exactly the right place. We're breaking down the actual mechanics of derivatives and micro-futures, pulling straight from the source material to give you the deeply structured foundation you absolutely need to survive in these markets. Let's get right into it.
So think about this for a second. Did you know you can trade the entire S&P 500 without actually owning a single fractional share of those companies? I know, it sounds totally counterintuitive, especially if you've only ever traded traditional stocks. But honestly, this is the foundational secret of the derivatives market. It completely changes how you interact with global finance because it allows you to elegantly separate the price action from the physical asset itself. Here's the core premise you absolutely have to nail down. When you buy equities, you're holding a fractional share of a corporation. You are an owner. But derivatives, they're fundamentally different. They do not represent direct ownership of a physical asset or a company. Instead, they derive their market value from the performance of an underlying entity. You're basically entering into a price and time-based legal contract. You're trading the agreement, the price movement itself, rather than holding the actual asset in your portfolio.
Okay, let's dive into this because this is where the harsh reality check kicks in for a lot of new traders. Unlike the stock market, where, a rising tide can theoretically lift all boats and everyone's portfolio goes up together, futures exist in a strict zero-sum environment. Every single contract requires a buyer and a seller to be created. That means for every single dollar you make, someone else on the exact opposite side of that trade lost a dollar. It is a completely closed loop of risk and reward.
Now, what if I told you that you could step into this highly competitive, zero-sum arena with just a fraction of the capital traditionally required? Exactly 1/10, to be precise. This simple mathematical fraction has completely revolutionized retail trading over the last few years. It's successfully bridged the massive gap between professional institutional trading desks and the individual trader analyzing charts at home on their laptop.
See, the traditional problem for retail traders has always been size. Standard institutional futures contracts, like the classic E-mini, are massive. They demand high capital and create extreme portfolio volatility. If you're a retail participant just trying to transition from paper trading over to live markets, stepping into a full-size contract is literally like trying to drive a Formula One car for your driving test. The financial exposure per tick is just way too high, and the sheer margin requirements can easily lock up your entire account in a heartbeat.
But here is the actionable solution. The exchanges introduced micro E-mini contracts, which are exactly 1/10 the size of their standard counterparts. And this changes everything about how you approach the market. Step 1, you start with micro contracts just to get your feet wet. Step 2, you can now fine-tune your position size with incredible accuracy. Instead of committing to one massive contract that blows right past your risk parameters, Step 3 allows you to manage risk with precise fractional scaling. You can systematically scale in and out of trades safely, experiencing real market depth without that paralyzing capital intensity.
So, your key takeaway for this segment? Microscaling is the ultimate tool for capital preservation. It drastically lowers your margin requirements and noticeably reduces your financial exposure per tick. You get all the benefits of real market depth execution, but crucially, you preserve your capital during wild, volatile swings. It is, without a doubt, the smartest way to manage your account volatility while you navigate live market environments.
Let's shift gears for a second with a really compelling question. What if you want the massive upside of being right about the market's direction, but you want absolutely zero obligation to actually fulfill a contract if you happen to be wrong? This is the core magic behind the options market, and it sets it completely apart from the strict two-way obligations of standard futures contracts.
This brings us right to the core premise of options mechanics. Options grant you the right but never the obligation to act at a specific strike price. It's a choice. You've got call options, which give you the right to buy the underlying asset. You buy these when your profit target is a rise in price. And then you have put options, giving you the right to sell, which you buy when you anticipate a significant drop. But because you have this valuable choice, you have to pay an upfront fee called a premium. And this brilliantly illustrates exactly what you're paying for with that premium. You're actually paying for two distinct slices of value. Slice 1 is intrinsic value. That's the actual built-in profit if you were to exercise the option right this very second. Slice 2 is extrinsic value, which is often just called time value. This represents the broader market's expectation of future price movement. But beware, this extrinsic value decays mathematically every single day as that expiration date rapidly approaches. The key takeaway here is all about strictly defined risk. As an option buyer, the absolute worst-case scenario is that the contract expires worthless and you lose only the premium you originally paid. That's it. Your risk is strictly capped. However, the seller, or the writer of the option, gets to collect that premium up front, but they take on the strict obligation to perform if the buyer actually decides to exercise their right.
Now, whether you're trading options or futures, you're dealing with leverage, which brings us to a massive misconception we really need to destroy right now. Margin in the derivatives world is not a down payment on an asset. It is a performance bond. It's a good faith deposit held by your broker specifically to cover your potential losses.
Let's look at how this builds into the core problem of leverage. You have initial margin, which is simply the capital required just to open the position. But look at maintenance margin. This is the absolute minimum equity you must hold in your account to keep that position alive. If the market moves against you and you breach that maintenance level, the consequence is immediate. You get a margin call or even forced liquidation of your position by the broker. You instantly lose control of your trade.
To avoid those brutal forced liquidations, you absolutely must have a crystal clear view of market structure to meticulously plan your entries and exits. You need actionable solutions to navigate volatility safely. Speaking of which, we want to take a quick moment to thank TradingView for sponsoring this segment. You can save $15 using our referral link in the description to get the absolute standard in charting. Having pristine, real-time charts is your primary line of defense against dropping below those dangerous maintenance margin levels.
So the crucial point is summarized perfectly by this quote from our source material. While leverage can amplify returns on capital, it equally amplifies losses. A tiny, almost imperceptible percentage move in the underlying asset translates directly to a massive percentage swing in your account balance. Respecting margin requirements isn't just a rule, it is the fundamental law of surviving leveraged markets.
Which leads us to a slightly terrifying question, honestly. In a zero-sum game with massive leverage, what happens if you make a brilliant trade, you win big, but the trader on the losing side of your contract goes completely bankrupt? Who exactly guarantees your payout? This is known as counterparty risk, and it is a very real, very dangerous element in unregulated markets.
But in the regulated derivatives market, we have a brilliant system. The core premise here is the clearinghouse. The clearinghouse acts as the central counterparty to every single trade. It mathematically breaks the direct link between you and the other trader. The clearinghouse officially becomes the buyer to every single seller and the seller to every single buyer. They stand firmly in the middle, guaranteeing the market's complete integrity.
How do they actually do this without going bankrupt themselves? Well, through a beautifully ruthless, actionable solution called marking to market. Step 1, the daily market fluctuates. Step 2, at the close of the day, the clearinghouse executes the mark-to-market process. Step 3, every single account balance is immediately adjusted to reflect current values. Profits are promptly paid out, and losses are aggressively collected from margin accounts daily. You never have to worry about the original trader paying up.
And as these contracts eventually reach their expiration dates, they have to be formally settled. The takeaway here is the critical difference between physical delivery and cash settlement. Institutional hedgers often want physical delivery, the actual logistical transfer of oil barrels or gold bars, but retail participants overwhelmingly utilize cash settlement. This is just a simple, clean exchange of the cash difference between the contract price and the final market price, which keeps you from accidentally taking delivery of 1,000 barrels of crude oil on your front lawn.
Let's look at one final, highly specific number. $1.25. It sounds incredibly small, right? But this is exactly what a single tick, the absolute minimum price fluctuation of 0.25 index points, is worth in a single micro E-mini S&P 500 contract. Understanding this exact micromath is completely non-negotiable.
What's really interesting about these specifications is that they basically act as your absolute survival dictionary. The core problem for new traders is flying blind without knowing these specific variables. You must know your tick size, your multiplier to find the total notional value, and monitor open interest to gauge actual market liquidity. Every single derivative instrument has a unique set of these specifications, precisely assigned by the exchange. If you don't know them, you don't know your risk, period.
And that is exactly why structured education is so incredibly vital here. If you want the actionable solution to truly master these mechanics, to nail your contract sizing, and to execute disciplined scaling rules, you need the full playbook. Grab your copy of The Funded Micro, Modern Future Strategies for the Prop Firm Era at franksreport.com. It is the definitive guide to putting everything we just visualized into daily, systematic practice.
We've thoroughly covered the structural reality of these markets today, right from the rigid zero-sum mechanics to fractional scaling, margin limits, and that beautifully ruthless daily marking to market. So I'm going to leave you with this final provocative thought. The clearinghouse is going to balance the books at the end of the day, regardless of how you feel about the market. Now that you understand the true mechanics behind the scenes, will you let the clearinghouse mark you as a winner or a loser tomorrow? The choice and the vital risk management is entirely in your hands. Thank you for joining this explainer. Keep your sizing meticulously small and trade smart.